Good morning, good morning. Let's do it, folks. Welcome to the Street's opening bell here from Post 35 on the floor of the world's greatest financial institution that is, in fact, the New York Stock Exchange. Let's get into it. Today is Monday, the 24th of October. I know, it's almost November, they said out loud. Yes, it is. I'm your host, JD Durkin. Opening bell rung just a moment ago here on the floor by Kinetic, ticker symbol KNTK. This in celebration of its first day of trading on the NYSE. Let's now turn our attention to what is on tap for this morning's broadcast. What a busy edition of the show. And sometimes, folks, you try your best to prepare a rundown when you have time and you think the show is going to go one way, and then you get breaking news there's going to be a new British Prime Minister. So we will dive into that in just a moment. Plus, Dow futures were up this morning as investors look to keep the momentum rolling after trading of last week, and that was the best overall week since June. Right now, a bit of green on the big board. We'll follow that very closely. Also, a huge earnings week on tap in the next coming days. Apple, Amazon, Alphabet, all of the A's, plus an M, Microsoft as well, all reported, other big names as well. We're also following news out of China, weighing on some big names after intense political reshuffling and some intense political images we saw there this weekend. Plus the latest on Tesla and the fate, like we said, of the next British Prime Minister, which has actually already been announced since I wrote that line an hour and a half ago. For more on those stories and so much more, we now bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Martin, pick your poison. Where do you want to start? I actually would like to start here with Rishi Sunak, if I can, set to become the next British Prime Minister after the last rival withdraws. That's the headline from the New York Times. Can I get the Martin Baccardax reaction and breakdown? Is this a surprise for you?
Yes and no, JD, to be perfectly honest with you. He was the front runner going into the weekend, and he has held some very serious and high positions in the government prior to this. He was Chancellor of the Exchequer, which is effectively the finance minister or the Treasury Secretary in American terms for the past 2 years. He's seen as a steady hand. He is seen as a conservative politician, both in name and in objectivity. He's not one to sort of explore the extremes of fiscal or indeed monetary policy. A steady hand, a conservative voice, and a respected politician. So I think the fact that he was able to ascend over the weekend was relatively expected, but it was certainly greased by the fact that Boris Johnson decided not to continue on the path towards challenging for the leadership. He did that late Sunday evening. There was suggestion that he didn't have the number of support that he would need from Conservative Party MPs in order to make that challenge. It turns out that he probably did, but he may be stepping back really as a result, JD, of the fact that whoever was to come through this leadership contest, and it does seem to be Rishi Sunak, they face just such an extraordinarily difficult challenge right now. There's no mandate from the British people. There's barely a mandate from the Conservative Party itself because members are divided as to who they would like to see lead the party and the government going forward. And the Conservatives only have I think it's 61-seat majority in Parliament. So the chances of legislation failing in sort of coming sessions is still very, very high. And therefore, the chances of a general election are very high as well. So while Sunak ascends to the top chair, the chances of them being there for a very long time, at least from where we sit now, they don't look terribly good.
I'm glad that that's more or less the point that you sought to drive home there, Martin, because I think from a lot of outside observers, at least people here in the States that maybe have a loose familiarity with British politics, they're going to sit there and say, well, Liz Truss just lasted the equivalent of 4 Anthony Scaramucci's, which is to say not a lot of time in the role. And then what does that say if the underlying issues there have not really been addressed? Is Mr. Sunak essentially in for potentially a bit of a similar fate? It sounds as if, from your perspective, the jury might still be out on that.
Yes, I really do think so. I mean, aside from the fact that the economic challenges are incredible at this point, given the fact that the economy is about to tip into recession, that inflation is running at the highest levels in 40 years, and Britain still hasn't really found its footing, having exited from the European Union just a couple of years ago, following on from the vote in 2016. I mean, all of those conditions would be extraordinarily difficult for any prime minister, but let alone one that simply doesn't have the mandate from the people and probably doesn't have the full support of the party. So just to give a little sort of civics 101 lesson, in the simplest terms, if a government goes to Parliament, brings forth a piece of legislation, and it's voted down, almost invariably there is a general election because the party in power can't be seen to hold the confidence of the House of Commons. So the chances that whatever comes first from a Sunak government, be it a budget or anything else, clearly all opposition parties are going to vote against it, and it's only going to take 60 or so recalcitrant or rebellious Conservative MPs to vote against it to trigger the collapse of the government. And there are many MPs who are simply so angered and embarrassed by the summertime machinations and the fact that we're now on a third prime minister in 4 months that they might vote against the government simply as a way of sort of kicking the chessboard in the air and starting over again. So whilst it does solve a short-term problem, and we've seen some steadying of financial markets in Britain today, it by no means addresses significant mid- and longer-term issues. And Sunak has his work cut out for him if he's firstly to find enough time to address them, let alone being able to have the talent and the ability to solve them over the longer term.
Yeah, poised to make history as Britain's first prime minister of color. We did just get an indication here, at least from the New York Times reporting, Martin, that King Charles III will be returning to London. Of course, Mr. Sunak must see the king now, of course, formerly the queen, now the king, to be officially installed as prime minister. We will follow those developments. It's going to be a busy next few hours, I suspect, there from our friends over there in the UK, and we'll follow those stories very closely. Thank you, Martin, for kicking off the conversation there and helping us answer some questions top of mind. I do want to get your perspective on the markets. Last week was one of the best weeks that we've had in quite a while. Maybe that's not saying a whole lot because everything is a bit relative, but I'm curious from your perspective, can we keep it going heading into this week? And what is top of mind for you from the lens of investors as we kick off trading on a Monday?
It's hard to pick one this week, JD, because it's so replete with potential data points and headline risk and everything else. I mean, we've got about 163, I think it is, earnings from the S&P 500, about 12 of them coming from the Dow as well. Obviously, we're going to have a first look at GDP data on Thursday. We will have key inflation data on Friday, which will be the most important data point prior to the Fed's policy meeting next week. There's interest rate decisions from the Bank of Canada, from the European Central Bank, and of course there's housing data and all the rest of it in between. So I think if I were to look at one thing in the overarching story, I would say that some of the messaging change, or at least the subtlety of it, from the Federal Reserve is a big part of the reason why we're seeing such dramatic moves in the markets over the past couple of days. Now, you and I addressed this a little bit last week, but I think it's found some traction over the weekend. There's been commentary from different Fed officials. Mary Daly from the San Francisco Fed, most specifically on Friday afternoon, suggesting that the Fed really needs to have a closer look at the impact of the rate hikes on the broader economy. What's interesting there, JD, is the fact that they didn't say that they're satisfied with the way that inflation is moving. It's still too high, still accelerating too quickly, and not returning to target in the way that they would like. But because they are moving so quickly on rate hikes, and you can imagine in the span of about 12 months, we've gone from 0 to 5%, which we've just simply never seen before in American history. There is concern about it having that sort of significant headwind effect to the broader economy, which is weakening already. Again, it largely echoes what they said through the minutes of their September policy meeting, but putting an accent upon it was allowing markets to take down Treasury bond yields. That, of course, had a significant impact in stocks, which jumped notably on Friday and are extending gains today. But it also suggests, and this is being played out in the bond market as well, JD, that investors are growing increasingly concerned about a near-term recession, and therefore they're buying bonds, which is pushing yields down. And that may give a false flag signal, if you will, in that stocks are rising because they see Treasury yields falling. But those yields might be falling not because of dovish Fed talk, but because more investors are worried about growth and they're buying bonds to protect it. That may mean that the gains we're seeing right now are harder to hold on to than they might ordinarily be. And in that respect, it puts this week's earnings slate into even more sharper focus, particularly on Tuesday and Thursday when we get the big four tech earnings.
Yeah, of course. So let's move there and talk a little bit about those big four tech earnings. Pick which one you would like to start, unless you want to do general analysis on all of them. Are there things that are unique to any of the big names, either whether it's Microsoft or obviously we'll get Apple and Amazon and a whole bunch. So I'll open it up to you, Martin. I'm not going to even ask you a specific question. Where do you want to start with regards to filling in people on what they need to know for a huge next few days ahead?
Probably the two most significant themes will be the pace and sort of acceleration of growth in the cloud space. That will be true for Microsoft and Amazon, of course, which have, and Google for that matter, which have significant businesses in the cloud computing space. Cloud computing, of course, being an excellent precursor of broader corporate spending as companies put together their budgets for 2023. So any look ahead that we can get from those companies on cloud growth will be incredibly important. And of course, the underlying dimension of consumer strength will be extremely important, and we'll likely get that, almost certainly, we'll get that obviously from Microsoft, from Amazon, and indeed from Apple. So it puts all four of those companies in stark focus this week because they offer so very many different ways to look at consumer and business strength, whilst also giving us just broader direction in terms of where those stocks are headed, but also where the broader economy is going to. It has to be remembered, JD, that those four stocks comprise around a third of the NASDAQ and about 20% of the S&P 500. So their movements, for the most part, are the most important and indicative of future direction for those two main benchmarks, and that's why their numbers are so incredibly important this week. And they all come after the bell as well, which is interesting because then investors can get a deeper look at them in the 12 hours after they publish, and of course when the pre-market opens in the following morning. So I always find that an interesting dimension as well. And I think thirdly, it's important to remember that all of these stocks are much more expensive to buy on a price to earnings basis than the broader indices themselves. In the case of Amazon, which trades at about 72 times earnings, it's far more expensive than the S&P 500, which trades at around 16 times forward 12-month earnings. So there is a high bar for these companies in terms of not only where they report at the headline level, but what also they say about their business prospects going forward, because the stocks are incredibly expensive, and therefore for investors to get on board and drive them, they need something a little bit different than the broader indices themselves.
That's some really good commentary there. Very solid, especially for the point about when the earnings reports are coming out, perhaps giving investors a little bit of extra time late overnight if they are so choosing to do so after the flurry of after the bell activity in the next coming days. To the point about tech earnings, of course, Snap, pretty disappointing report last week. Is there any set, right? We talked a little bit about it being sort of a canary of what's to come in terms of the general tech landscape coal mine. Is it your expectation there's a little bit of a lag after Snap last week, or is there, or are the other names hoping that Snap is a one-off and they get to move forward and not really have to worry about what Snap said a few days before?
We'll probably get a better crystallization of the Snap commentary from the Google earnings, simply because YouTube is such an important component of growth in that company's stock. And of course, their indications of where they're seeing advertising spending and the growth rates, and to what degree various economies around the world are suffering as a result of geopolitical tensions or what have you, those are likely to be more sort of more pertinent, I think, for the broader investment community, simply because of the breadth of Google's business, and particularly the breadth of YouTube's business, which is far more significant than anything we're seeing from Snap. Again, Snap's commentary about slowing ad spending is certainly important, but it probably has a level of importance for the broader marketplace as a result of it being one of the first tech companies out of the box. And therefore, the reaction is a little bit more visceral than it might ordinarily be. With the case of Google, I think we can either crystallize or indeed counter the commentary that we saw from Snap last week. So the earnings call will probably be more important to some degree than the headline numbers that come out of Google after the close of trading on Tuesday.
Martin, because you cover the space so closely, and again, I always try and think about our broadcast through the lens of someone who might be tuning in for maybe the first time, has a casual familiarity with trading, wants to learn more. What advice, as we enter a busy earnings week, do you give maybe to a relatively new investor who says, I want to learn more? Hey, I'd love to even, can I dial in? Can I listen to these calls? Can I read the transcripts after? Having done this for so long the way that you have, what do you advise someone maybe just starting out in his or her investing career, in terms of making sure that you actually hear personally, oftentimes, what these company CEOs have to say in such a crucial week?
It's a great question. I think for the most part, if I were to give a couple of pieces of advice, the first thing that I would say to any very new investor would be not to attempt to try to trade your way around an earnings season. In fact, it's probably best to get your feet underneath you over a series of quarters. In other words, simply be invested on a passive basis in one of the major indices or through an ETF, and then simply watch and listen to what the companies are saying over a number of quarters, because you'll begin to develop a narrative that will allow you to make investment decisions more specifically. So in the case of, say, let's take Apple, which reports after the bell on Thursday, their conference call will often talk about not only the broader global macro situation, but the mechanics of what they are seeing in growth prospects in the various economies around the world. So there'll be commentary on China, on Europe, on the United States. There will be commentary on supply chains, on consumer strength, on demand, and various other things like that. When you are able to see more granular commentary like that, you can then feed that into your own investment thesis and make decisions based on that. But it's important to see it over a number of quarters, because what you want to see is repetition. In other words, if dollar headwinds are beginning to abate, you want to see that not only in these quarters, but in a couple of more quarters before you can be firmly convinced that it actually has slowed significantly enough that it's not going to be the blunt on earnings that it has been in the past. Conversely, if there are still suggestions that dollar strength is going to remain a headwind, you want to look for that, see it over the next couple of quarters, and then decide. And you can use that technique with however you'd like to feed into your investment thesis, by listening to what the company executives are saying and then drilling deep into it and applying it to what you see in terms of your portfolio. But in that respect, JD, I do think it's important to make sure that new investors don't try to trade through the earnings season, because the volatility between the headlines and the conference call can be extreme. And what would seem to be, let's say, bullish for a stock at a headline level will very often turn around quickly when the company executives begin speaking to the investors about typically a half hour to 90 minutes later.
I had a sneaking suspicion that would be a great question to ask you, and you gave a truly terrific response that I think all investors should listen to very closely. Martin, thank you for that. Before we moved on from how busy the next few days are supposed to be, I wanted to give you an opportunity, Martin, to address anything related to the inflation data. We did talk about it a little bit earlier, but anything else that was top of mind for you that maybe I didn't get to address or ask about specifically. We'll get that really first reading for U.S. GDP later on in the week, I believe on Thursday. Any other expectations there we didn't otherwise talk about before we move on to talk about China? We got a lot there, but anything left on inflation for you?
The one thing that still sticks in my mind, JD, with respect to inflation is the strength of the U.S. job market. I mean, we're still, even though we had a big change in the number of open positions over the month of August, we're still looking at 10 million unfilled positions, and company executives are saying they're still finding it difficult to hire people. And that does indeed suggest faster than expected average hourly earnings increases for the next non-farm payroll print, which unfortunately comes after the Fed decision on November 2nd. But nonetheless, we'll get that PCE data on Friday, and that is the Fed's preferred gauge. At a core level, it's probably going to decelerate, and that will be welcome news. But because the Fed has that dual mandate, they are going to be very aware and very acutely cognizant of changes in the labor market. And at present, the labor market is still so strong and wage growth is still so robust that the Fed simply can't have confidence that its rate hike measures are having the effect that they need to have on inflation writ large. So therefore, I do think we probably won't get the clarity we need until a couple of more non-farm payroll reports. And again, unfortunately, the first one will come in the latter part, a few days after the Fed decision on the 2nd, and then again in early December. So for me, the job market, JD, remains probably the most important component to inflation because arithmetically some of the other measurements are going to start to slow irrespective of what the Fed does.
All right, Martin, let's now turn our attention back overseas, and I do want to get your perspective here on Xi Jinping's restructuring. And again, we did see some rather incredible images emerge out of China in the last few days, and you know of which I speak, politically speaking. And now there is, of course, an investor reaction. Stocks there are taking a hit in the form of Alibaba, Tencent down as well, both down double digits. What is causing that sell-off specifically, and what should we know about Xi's restructuring? What a story this has been the last few days, Martin. What should we know for Monday?
It's absolutely incredible, JD. It really is. I mean, we're looking at a territory in the Chinese political landscape that we simply haven't seen for 4 or 5 decades. Xi Jinping secured an unprecedented third term as president after the Communist Party Congress, which took place all of last week and into the weekend. And he was able to also significantly restructure the Politburo Standing Committee, which is effectively the cabinet of the government, and the eight men, as it were. There was 1 woman prior. There's none now, who make the most important decisions in the world's second largest economy. And the fact that the restructuring included so many Xi Jinping loyalists suggests that he has just simply consolidated his grip on power to a degree, again, that we haven't seen really since the late 1960s. That's extraordinarily difficult for investors to navigate, because ultimately so many significant policy decisions are going to be seen through the prism of one person. And that person has expressed a view that is autocratic in political nature, and certainly is erratic at best from an economic point of view. So investors are betting on zero COVID policies remaining in place well into 2023 and potentially beyond, as the country tries to make sure that it doesn't have any infections whatsoever and is willing to shut down economic activity in order to achieve it. And they're also concerned that the crackdown that we've seen on big tech billionaires and the activities of big tech companies is likely going to accelerate as well. And that, of course, has big implications for some of the most favored stocks from foreign investors. So the reaction in markets was exactly what you would imagine, JD. We had an index in Hong Kong, which tracks the biggest stocks in China, falling the most since 2008. And we're looking at double-digit percentage declines for Alibaba, for JD.com, for Tencent, and for Baidu, the 4 biggest Chinese stocks that are listed here on U.S. exchanges. It's going to be really difficult to unravel those concerns over the months ahead, because with stating the obvious, the Chinese Communist Party is not one given to great transparency about their economic plans. They delayed GDP data, in fact, last week in order to make sure that it didn't disrupt the discussions that were taking place in Beijing. That GDP data was a little bit stronger than expected, but nobody really believes the veracity of the numbers anyway. So it does suggest that there's even more sort of murkiness with respect to how the economy has managed to grow, despite the fact that it continually shuts down activity in order to tamp down COVID infections. Foreign investors are starting to lose faith. The yuan is trading at a 14-year low, and we're looking at a property bubble that could burst at any time, creating a debt crisis in China that many people anticipate could rear its head in the coming years. So there's so many questions about the Chinese economy, but the last thing they needed was the consolidation of grip in power from an authoritarian leader. And unfortunately, JD, that's exactly what was delivered over the weekend.
And I also wonder what led to China's surprise price cuts or Tesla rather surprise price cuts in China, Martin. And I wonder if there's a Tesla angle. A Tesla angle. It's Monday morning. Words are difficult without coffee. Pardon me. Is there a Tesla angle here specifically that investors in that company should keep an eye on? Obviously, it's a company that has had to deal with the headwinds in the form of that nation's COVID zero policy, something you also just talked about here. But aside from just the truly remarkable nature of the politics at play and this unprecedented third term, is there an impact for some of these multinationals or companies specifically like Tesla, I wonder?
Well, that was the first thing that came to mind, JD, when I saw the Tesla headline this morning. They're cutting their prices for the Model 3 and the Model Y. In the case of the Model Y, by about 9%. And that's the first price cut that we've seen in China this year from Tesla, when in fact they've been raising prices in the United States to compensate for the input cost increases that we've seen as a result of supply chains and raw material price hikes and broader inflation and everything else. So this did catch me by surprise. But when I looked at the China sales data for the summer and the first month of the autumn, it was still really solid. In fact, China accounted for a record number of Tesla car sales over the month of September, just over 85,000. So the demand equation, again, murky, but certainly not one that you would have immediate concern for. It's the biggest electric car market in the world. Indeed, it's the biggest car market in the world. And Tesla does have a foothold, both in brand terms and in production terms, that most of its rivals simply would love to even think about, let alone compete with. But the price cuts do suggest that there's softening demand and there's concern about broader growth going forward. And whilst they were surprising, I think they do raise questions, particularly with a company like Tesla, who is seeing profit margins narrow, both on a quarterly and a year-on-year basis. The two components just don't mix together. You don't cut prices when your margins are narrowing. So it only points to one thing, and that's a demand concern. And we probably should take Tesla's word for it, because they are on the ground in a way that we are not. And they may be able to offer a signal to demand softness that we otherwise wouldn't see from GDP or other data.
Thank you for that as well, Martin, for the Tesla-specific angle on the story in China. That's going to be a story that I suspect you and I will be talking about every morning here on the broadcast for quite some time. Before we wrap things up on this Monday, as we just cross into the 10 o'clock hour here on the East Coast, Martin, I do want to get your perspective on the truly wild week that was in the world of sports. What stood out to you? That it's fair to bring up NFL. I know we had your Dolphins. I'd rather not talk about baseball, being a beloved Yankees fan, but it should be a good World Series nonetheless. What is top of mind for you? And the best part of the sports season is right among us.
So much over the weekend. It was a lot of fun to watch, wasn't it? You know, the F1 season came to a conclusion, which is something that I enjoy watching as well. I think the baseball gave us maybe a surprise World Series with a dramatic home run for the Phillies, wasn't it? That was really fun to watch. And probably a legacy-defining swing, if you will, for Bryce Harper in that respect. Nice to get a win for the Dolphins as well. But we don't know as much as we would like, I think, in the NFL as to who the best teams are beyond perhaps one or two. But the overarching story for me over the weekend, JD, was it might be the end of an era for two of the most amazing athletes of the past decade in American sport, and that is Aaron Rodgers and Tom Brady. They are finally starting to act their age, and I gotta say, I don't get a whole lot of joy from that. I was much happier when they were defeating Father Time, but it looks like it's catching up to them.
Yeah, it absolutely is. I know that there's going to be no shortage of attention, especially in that Tampa Bay locker room, with a sense of always like, oh, things will settle down, things will settle down. They said Brady would take Wednesdays off. He'd be able to have it all in control. Not so much. I think you're now safely in the break glass in case of emergency phase of the Tampa Bay Buccaneers season. It's probably not far off there in Green Bay as well. We will see what happens. We've got the World Series, of course, will be kicking off. And yeah, we'll see how it goes. What a time to follow sports and be a sports fan. And I'm appreciative we get to break it down every morning here on the show and have a bit of fun in the process. Martin Baccardax, thanks for helping us get smarter on all of these issues and so much more. Martin, thanks a lot. Have a great day.
Thanks, JD.
You got it, man. All right, that's going to do it for the Market Open here from the floor of the New York Stock Exchange. Stick with The Street for more on these and all of the major market stories that matter to you. We'll see you later.